Let's get to our wrap the week every Friday. Our goal is to wrap the week. That means look Friday to Friday and just see how things have evolved, see what's changed in the last, in this case, 4 sessions. I did want to point out, just start with a poll here very quickly. We asked you recently on StockCharts TV and elsewhere, which industry group do you think has the best performance in the next 3 months? So really going through, almost year end here, going through mid-December, which of these groups, and we gave you 4 choices: semiconductors, home builders, biotech, and banks. And the votes are in. Almost a third of you, the number one answer, semiconductors, the SMH. Second was home builders, around 26%. 26% of you also said biotechs, and then only 16% said banks. So of course, as a contrarian, I immediately go to the chart of the KBE to see if there's something in there. Is this a great contrarian play that I could maybe bet on the fact that this is not a widespread idea? And, I'm not surprised we're sort of self-selecting into a group of trend followers, a group of chart aficionados, if you're answering our poll in the first place. So I think you're recognizing what I am too, which is when you look at banks, just the relative performance has been, essentially flat to down. Really it's been negative since the entire beginning of the year. We're down 36% from where we started, on January 1st of this year. So it's been brutal, as most things are sort of back, sort of testing new highs or above new highs or previous highs. And here's the KBE down well below its 200-day moving average, down below 2 downward sloping moving averages. Now, the number one response was semiconductors, which is interesting. If you asked me to respond, I would actually say probably home builders. I don't know though. I get either of those two. I think you could make a good sense for sure. Biotechs have rolled over. I think at this point, it's hard to assume that that's going to be the best place unless it's more of a macro play and you're ignoring the chart a bit. I think with home builders, these are the ones out of all 4 of those groups have really been testing, remaining near new highs. If you look at Lennar, Pulte, and others, but we will see. Semiconductors is a decent bet there. Let's continue on. Let's wrap the week. Look at how today played out, and then let's focus just on the longer term charts. As I mentioned, the S&P flat, but the breadth characteristics have continued to weaken. I think the real story here is the underperformance of small caps relative to large. That's a theme that continues to play out. The strength in industrials and materials. When I talked with Fred Meisner this week, he said his best ideas were in industrials and materials. And so far since Fred's appearance, it's been a pretty decent bet, with those 2 sectors actually doing meaningfully better than others. Financials were third today. Technology leading the way lower. And again, that's, what I guess the big debate here is: this an overall market sell-off that we are in the early stages of? Is this inning 1 of a 9-inning game that goes lower? Or is this just rotation? And right now, what today was essentially more of a rotation, with industrials, materials doing well, technology doing poorly, and everything else kind of in the middle. But again, this is one day. Overall, the trends are what we want to start to reflect on and start to think through. Let's go to the Mindful Investor Live chart list. Let's take the remainder of our time and really focus on the long-term charts and how they've evolved. We're going to start with the market trend model. This is a model we review every week together, something I've used for a number of years. And, think of it long-term, medium-term, short-term. Long-term is based on the 21 and 34-week exponential moving averages. That turned positive in June, remains positive through now. That wouldn't go negative unless there's a pretty severe sell-off. You really have to change trend for that to sort of signal. The medium term is here. The 12 and 26 week averages is what that uses. That's sort of the traditional weekly MACD or weekly PPO setting. It's getting closer to a sell signal that has not registered yet. Overall, it's still in the positive camp. The short-term signal, and this is more of a placeholder for me, looking at the price relative to the 5-week average. Are we above or below that on a closing basis? And really, for me, the short-term is driven by the daily chart, which we're going to look at in a minute. But I like having an indication just on this chart showing me all 3 timeframes, and that actually did turn negative this week. Did not last week. It actually held on Friday as we sort of rallied a little bit, but the follow-through that we saw this week really pushed it to the negative side. So when I update these over the weekend, it'll be long-term bullish, medium-term bullish, short-term bearish. And one of the comments I got when I shared this earlier in the week was essentially, if you're waiting for a long-term signal to turn negative, you're going to be waiting forever. You're going to wait until after the markets turn lower. And that's right. That's actually by design. I wouldn't tell you, I don't run a fund or anything based purely on this. I think that's oversimplifying things, to be honest with you. But where I would say is at a market top, at an inflection point, you naturally start looking more at the short-term reads just to understand the short-term dynamics. Because as you said, as you imply by the question, as things roll over, it'll be reflected on the short term, and then the long-term trends will eventually recognize that it's not just a brief pullback, it's more of a downturn. I think that's the scenario we're at, where in the short term, it's now looking weaker rather than stronger. And the question is that enough to pull down the medium trend? And is enough for that to pull down the long-term trend? That's not something we can answer just yet. I think that's something we have to figure out through the course of time. All right, that's the market trend model. Let's go to the next one, which is the daily S&P chart. And as we talked about, this week, I think 3350 was that first sort of line in the sand. We hit that earlier in the week. We retested it again Thursday and Friday. We've now closed below it 3 out of the last 4 sessions. So overall, I think we're really right at that point. It's hard to really think that this is the signal, the trigger, until we get below the 50-day moving average, which we traded below today, but actually closed back above. So going into the beginning of next week, we follow through that, which I expect that we will. I think we'll go further down. I think the real line in the sand for people, this is more of a short-term thing, which I think I've seen enough weakening breadth to suggest we're going to get a little bit further downside no matter what. But I would say 3,200 is really the key line. That's the peak from June. We retested that in July. That's a pretty solid level and a previous inflection point a couple times. That's where I'd be looking for price support. If we're able to hold that, that means you could, perhaps we've pulled back enough that you expect further upside. If not, I think you really have to do some soul searching about the potential for further downside risk. It's never too early to think about what levels we might break that might cause you to revisit, a long positioning or a long thinking. I was on Bloomberg TV yesterday and showed the broadening top, which I'll show you here in a second. It's really the long-term pattern, looking at highs and lows. Give me just a second here. Random social charts. Let's see, right down here, SPX. I should have come prepared with this one for sure. But basically, I have a chart that shows the evolution. It shows basically the weekly chart, and it shows the broadening top pattern that we've seen. A broadening top is essentially when you have higher highs and you have lower lows. I'm not seeing it on here. It is. There we go. So say I need to come up with a better titling. Yeah. So basically, what I was trying to do. This isn't even the right chart. I'll go back to this one. I'm so sorry. Here at the weekly chart of the S&P, if we look at it, the idea is that you have higher highs and you have lower lows. And if you look at the weekly chart for the last couple of years, since 2018, highs getting consecutive higher, lows getting consecutively lower. And the challenge is, if you connect the high from January 2018 to the high February of 2020, that lines up actually really well from the high we just saw in the last 2 weeks. And the question is, does that mean we go all the way to the bottom of this broadening top pattern, which would take us down to S&P 2100, S&P 2000? I think the chance of that happening is pretty remote. I don't think we would get all the way down there. But if you look at the 1970s, it almost looks like a bit of a broadening top pattern. The way you saw that bear market period was starting to be over was the next low kind of finished up here. It was more of an inverse head and shoulders, yet a higher low. I don't think it's impossible that we get a move back down into these levels, 2,500, 2,400. I think that's possible. And again, the good news is there will be a lot of points between here and then that we would cross and be able to figure out together. But also on the weekly chart, I think the bearish divergence jumps out at me with this most recent upswing that we've seen in recent weeks. Really much less momentum on that upswing from what we saw in January. So it really is speaking to sort of that long-term sort of topping pattern. And remember, markets can correct in 2 ways. It can correct in time and in price. We may just spend a lot of time backing and filling and basically pleasing no one when you go sideways. The lack of up or down direction, we just go sideways, is probably the most painful of the 3 directions we can go. But again, let's focus on some of the key levels and see how those trends evolve. Let's go to the next chart here. This is looking at the breadth by cap tiers. I haven't completely updated this color-wise. I usually do that over the weekend, but it's worth noting that the common stock advanced decline line broke down this week, basically showing weakening breadth. That's now a pattern of lower highs and lower lows. The mid-cap breadth index turned lower earlier this week. The small-cap breadth index turned down first. Just in the last day or two, this is as of yesterday's close. Today, when we update, I wouldn't be surprised if it's around the same level, if not a little bit lower. And I think all 4 of these now have broken the swing low from mid-August. So while the S&P has rolled over, I think the real tell is the fact that you saw lower peaks in most of these breadth readings, and now they're breaking through their swing low. And this pattern with higher highs in the S&P breadth, lower peaks in small cap breadth, lower peaks in the New York Stock Exchange breadth, you see a lot of similarities right now with the last 4 weeks of higher highs here and lower highs in all the other readings. So it's lining up with previous bull market tops as well. Looking at new highs and new lows, we talked about this yesterday. I think we really focused on breadth in good deal. And if you missed that, I'd encourage you to go back on our YouTube channel, because we talked a lot about the individual breadth charts and how they were evolving. But what I wanted to point out here was we had a consistent number of new 52-week highs that pretty much evaporated. We're starting to get a couple of new lows, but really nothing. Everything's sort of in the middle. But the signal here is that all the new highs that we've been seeing have essentially gone away. There really isn't anything making new highs this week, especially in the last couple of days. This breadth indicator, looking at percent of stocks above their 50-day, has broken to a new swing low. I think that's pretty telling. It'll be interesting to see if it remains above where we saw in June. This is when breadth was really high. It came down to below 50%. And right now we're nearing that 50% level. We'll have to see how things play out as we lock in today's closing values. It's not in there yet, but that's certainly suggesting a bit more of a short-term top. And again, the difference here is almost 100% of the S&P was above their 50-day here at the June peak. Only 85% were above their 50-day here about a week or two ago. And now it's almost 50%, which means 30% of the S&P has rotated back below their 50-day in the last couple days. This percent above the 200-day, if we remain above 50, that's sort of the longer-term bull market signal. If we break below 50, that tends to make things look a little more bearish. In terms of sentiment, just very quickly, we're going to talk about the name exposure index a little bit later, but just wanted to point out with the AAII ranking, certainly a rotation back towards more of a bearish perspective. And this is, again, the individual investors. It's not a comprehensive look at sentiment, but certainly speaks to how this subset of the investor cohort is voting right now. Almost 50% bearish, outnumbering bulls 2-1, with just big change from the last couple weeks. Let's finish out just looking at some of the ratios and how they've changed, and then we're going to take a quick commercial break here in a minute. Looking at the ratio of consumer discretionary to consumer staples, the ratio is actually holding up okay. The challenge is, if you look at the relative strength of consumer discretionary, it's actually doing very well. Also, the relative strength of consumer staples holding up okay. The big difference is, the equal weighted version clearly favoring consumer discretionary, and a lot of the staples charts, as we talked about on Tuesday's show, really starting to show some pain. That's like KHC and General Mills, a bunch of those. The last one that I noticed, we're out of time. Sorry for missing it here. Semiconductors have rolled over on a relative basis, and I think I actually wrote an article just before the show for our Chart Watchers newsletter, which comes out every Saturday morning, talking about this rotation away from semiconductors, how it lines up with the weakness in the NASDAQ, weakness in the technology sector that we saw again today after seeing that over the last week for sure. Again, it's still a short-term read. It's still telling you the beginning of that inflection point. But if that trend continues lower, really speaks to some weakness from a key group, semiconductors, which tends, in my opinion, to be a good market tell, because it's a good way of measuring the overall health of the economy.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.